Good afternoon, and thank you for joining us for our webinar today that will investigate risk reduction and cost control through better trading fee management. My name is Steve Edge, principal of AsiaETrading.com. Well, it's a pleasure to cover a topic on electronic trading not related to HFT, algos, or competition as we explore, in my mind, an often overlooked segment of the business. We're joined today by some very knowledgeable industry experts who will lend insight into the bigger picture of this practice. Our panelists are Nick Perry, Head of Business for Brokerage Japan, Zenon Kapran, founder of Kapronasia, and Barnaby Nelson, Head of Client Development Asia, BNP Paribas Securities Services. Welcome, gentlemen, and thanks for joining us today.
Thanks, Steve.
Thank you.
During this webinar, we will investigate the degree in which firms have insight to who and how much they are paying trading fees to, why firms may not have visibility into this process, how firms are utilizing comprehensive administration of their business partners to gain a competitive advantage, and what strategies they are employing. But just some housekeeping first. This webinar is scheduled to run for 60 minutes with a 50-minute Q&A with the last 10 minutes for, with 50-minute discussion with our panelists, and the last 10 minutes will be set aside for Q&A. We would like to encourage all participants to ask questions throughout the discussion using the chat feature. We will answer as many questions as we can. However, any unanswered questions will receive follow-up after the webinar. You can also use the chat feature to communicate with us if you are having problems with the sound or picture, and we will do our best to correct it. So let's begin. I generally like to start the webinars by giving a brief introduction, but instead Zenon of Kapronasia has done some research on this topic and has prepared a brief presentation on his findings. I'll hand it over to you, Zenon.
Thanks, Steve. Thank you, everybody, for joining the webinar today. So, yes, as Steve mentioned, I just wanted to start off and give you a little bit of background on the report that we've recently completed. We will be sending out information at the end of the webinar in the next day to all of the registrants on the webinar about how to obtain a full copy of the report. We don't want to take this whole webinar time to actually go through the details of the report, but I wanted to give you a couple of key insights that we found during the report itself. So the title of the report was Insights into Fee and Commission Management in Asia, and that was produced by Kapronasia, our firm, and sponsored by Brokerage. The methodology that we used for the report was very standard and comparative to what we do for most of the research that Kapronasia does. It was based on a combination of secondary research, which included internal knowledge that we had already, government reports, published reports from vendors and financial institutions themselves, and then that was supplemented with primary research. So we went out to the market and spoke to a number of the financial institutions in the market, vendors and industry experts to find out what they thought about fee and commission management. And really, the purpose of the report was to get insight into primarily 4 points. First of all, how firms are managing commissions and fees today. We wanted to look at the business and technology challenges currently faced by those institutions with regards to fee and commission management. We also wanted to take a look at the benefits of a fully automated commission management system. So what could they expect qualitatively and quantitatively by implementing these systems, and then wanted to look at the methods of measuring ROI, because that's one of the big things that typically this space has been difficult to kind of quantify, and that's partially because customers aren't so happy with revealing the return on investment that they've had from implementing these automated systems, and partially just because the systems are relatively new in the market. So when we look at the market situation, although markets around the world are for 2011, some will end up for the year and some will be down for the year, clearly one of the global trends within capital markets in general is that volatility has returned, and kind of volatility and uncertainty with what's happening in the markets What's happening in Europe is a good example right now. I mean, markets are waiting with bated breath until Friday, when the European Union will hopefully reveal firmer plans for going forward and taking care of their crisis. When we were doing the research, we found kind of a structure from the IMF that we felt really summarized the 4 stages of the global financial crisis, because we still feel that we're in the financial crisis that started a number of years ago, and that really started with private debt. So when we look at the subprime crisis, which originated in the US with consumers and banks, and that is something that the IMF recognizes as kind of the first stage of the financial crisis. That then shifted into a banking crisis, so the systemic crisis that started in the United States on the back of this private debt crisis, and then expanded over to Europe. The third stage being the sovereign crisis, where problems in primarily in the EU, with sovereign debt, so countries being able to maintain and service their long-term debt burdens in some of the advanced economies, and then kind of where we are today, which is the political situation. So looking to find a political solution to this financial industry problem that we have. Behind all of this, Asia still remains a key driver of global growth, as it has been over the past couple of years. I think one of the key characteristics, though, that we're seeing in Asia now is, especially with Europe and the United States slowing down, the economies of Europe and the United States slowing down, is that domestic demand is starting to pick up in some of the key Asian economies, such as mainland China, to start taking up some of the slack that the lower exports are having on the economy. So as the Europe and the US demands less from China, less from India, there are fewer exports, but that in the GDP in a lot of these countries is shifting towards increased domestic demand, which is really one of the criticisms that they've had in the past about the economies in Asia. So with that being the situation, and the current market situation, with the volatility, the financial crisis still in play, and the Asian markets still being kind of the driver of global growth, or the bright spot, so to speak, in global growth, there were 4 key fee and commission management challenges that we heard when we were speaking to the financial institutions that we used, or that we spoke to during the research. One of the first key points is siloed business and technology groups. This is nothing new for the financial industry. This has been a challenge all the way along, but especially in the fee and commission management space, we found that this was largely limiting what organizations could do to really have clear insight into what they were paying, how they were paying, and if they were paying the right amounts for their trading fee and commissions. One of the organizations that we talked to, even within the same desks within the organization, they had multiple relationships into the same brokerage, and each of those relationships had different rates that they were paying to the broker. So clearly the siloed business and technology groups limit what can be done in fee and commission management, and it is increasingly a challenge. The growth within Asia, the alternative trading venues starting to come into play here, more options in terms of where investors in Asia can invest, is resulting in increasingly complex and duplicated agent relationships. We mentioned before about the siloed business groups and potential relationships even between desks to the same brokerage, but when you look at where a lot of the investors are looking to trade now, with things opening up for Chinese investors, with investors investing in China, there's an increasingly challenge around managing these relationships and keeping track. And that often means that organizations have a more difficult time managing those fees and managing those commissions that they're paying. The third challenge that we noted was outdated and disparate technology. So this is nothing new for organizations. I mean, financial industry organizations are known for having mainframes from the 80s, and a lot of vendors make a lot of money off those old mainframes that are so difficult to change. But that technology the kind of difficult to change technology infrastructure affects the ability of the business to change, and to be able to take all of this information on fees and commissions and bring it together in one place is quite challenging with that. And the fourth and final point that we had was ensuring continued best execution, so making sure that you're getting the best for your own company and for the people that are investing with you, ensuring that you're getting the best execution by not only getting the best prices, but using the best brokerage relationships that you have. And that was one of the challenges that they found as well. Organizations we spoke to had a number of different approaches that they were using to have better insight into the fee and commission management. In many cases, there were manual checks. Now, in most organizations, manually checking the thousands, if not millions, of brokerage transactions isn't really feasible. So typically these manual checks were on a subset of that, or within a business unit, or a certain percentage of the overall. But some organizations were actually doing manual checks. So essentially taking an invoice from, in a particular case, from their brokerage and matching it up with a trade, or in the case of a broker who was then checking their invoices that they were sending to some of their clients and matching the invoices to the trade. So in certain cases there were manual checks. In many cases those manual checks were more spot checks. So they would use a statistical sample, check 3 or 4 trades over a certain period of time and try to match those up with the invoices to see if they matched, and to see the statistical relevance of the fees that they were looking at and if they were accurate. In certain cases, organizations were doing nothing and just assuming that they were paying the right amount for their fees and commissions. And in some cases, there was outsourcing. So organizations had non-specialized BPO providers, in certain cases sending a stack of electronic or paper invoices to India to have them be manually checked. So essentially exporting or outsourcing the manual checking to an outside party. And then in some cases using a specialized provider, whether that was a brokerage that would provide it as a value-added service, or if it was a completely external organization that was providing the service as well. And then in many cases, organizations were doing updating of existing technology, so not necessarily replacing the technology, but using what was there and trying to work from that basis. Now, a lot of those approaches made sense in the past, and one of the things that we found is looking at the vendor offerings out there in the marketplace now is there are very credible solutions that technology vendors have on the market, software, hardware solutions, to help manage the fee and commission management process. And so these are solutions that take a variety of different inputs and feeds from different data sources to essentially reconcile what you're paying for your trading fees with the actual trading that's happening. And over the past couple of years, the really big finding that we had from the report is that these systems have really become enterprise class systems where many large organizations can use them and generate a positive ROI. The challenge for these organizations in implementing them is really proving the ROI across the organization, because it's not just a question of the front office, middle office, or the back office, but it's all three, because accurate fee and commission management really affects all parts of the organization. So a few of the benefits that we found that organizations were finding for using an automated system were reduced trading costs and better cost control, overall, what you would expect, better insight and analytics into the business itself. So when you look at the results that some of these systems put out, you get a much more accurate view of trader performance, including fees and commissions, not just including the prices that they're getting on the trades. Optimized working capital and liquidity risk management was a key, being able to predict how much you're going to pay in the future without having to wait for the invoice to arrive. So at the end of every day, you'll know what your commissions and fees should be in the future, which allows you to accrue that money and not have those risks, those large risks in your liquidity. And risk control and compliance. And this was compliance from internal audits to be able to match trades. If there was a question on a trade as well, having the fee and commission management system there, the automated system, allowed organizations to be much more succinct and automated in investigations in hindsight. I won't spend too much detail on the return on investment, but as we mentioned before, it's really across the organization. There's front, middle, and back office benefits of using an automated commission management system. And it's not just a question of costs. There was an ROI in staff productivity and vendor and partner relationships. Obviously, if you're able to reconcile your invoices faster or issue your invoices faster and more accurately, that provides a better relationship with whoever you're invoicing or whoever you're paying. And so we found that that was one of the potential returns on investments. And then IT savings and rationalization on the back end. So by combining many of these systems into one larger system that takes feeds from multiple different systems and really combining these processes into one system and one output really helped organizations to realize an IT savings. Now, I've gone through this fairly quickly because I don't want to take up too much time from the panel itself and the discussion we're about to have. But we are, as I mentioned at the beginning, we are making this report available for free to any of the registrants that were on this webinar. And in the next couple of days, we'll be sending out a link with where you can go and download it. The pre-release link will be sent to everybody by email. In general, it will be available next Monday. And then it's also available on brokerage.com and kapronasia.com. So really that was it for the introduction. The report gets into much more detail, and I would encourage everybody on the call to take a look at that when you get a chance so you can see a little bit more of the findings that we have. It's about a 16-page report and has some really good insight into what's happening in the market. And as Steve mentioned before, if you have any questions about what I've talked about or the report itself, feel free to get in touch with us during this webinar or after the webinar as well. So with that, I'll hand it back over to Steve to start our panel discussion.
Great. Thanks, Zenon. Certainly a lot to digest. Well, before we talk about some of the findings, I'd like to start the first opinion poll of 2 during our webinar today. First question, does your firm, everyone see that? Yes. Does your firm have a clear picture of how much, does your firm have a strong need for better trading fee management? No, somewhat, maybe, yes, I think so, yes, definitely. I'll give a few more seconds for people to vote. Votes are coming in. All right, let's close the vote. So interesting findings. 25% of those who voted said somewhat, and 75% said yes, I think so. Definitely telling indeed, and perhaps supporting some of the findings that you came up with there, Zenon. Well, let's move on to the panel now. I think just to kind of frame what the heart of the panel is. What is meant by trading fee management? Nick, I mean, how do you categorize and define trading fee management? And why is it necessary?
Steve, I think that when we first came to this, trading fee management was just considered what Zenon alluded to as a reconciliation and paying the bill for services consumed. But as we got into it and we worked with people, this has changed to being trading fee management is a sort of a cradle to the grave process where you want to calculate, you want accuracy, and you want to do it for every asset class, every product that you do, for every business entity, every business unit that you come across, whether you're paying the money or paying or receiving. So every activity you do, whether it be the charge or an event around it, it's about everything. It's not just about the reconciliation of a bill that arrives. It's about everything that you do, and it's about looking at it from your point of view as the person that's receiving or paying the money, not the bill. So it's a sort of, the process has turned on its head in the time that we've been looking at this.
Okay, thanks, Nick. Barnaby, as from BNP's perspective, how do you define trading fee management? Do you agree with Nick? Do you have a different view?
Yeah, I mean, I think Nick's broadly right. I mean, I think I'd be interested amongst the 75% who actually think they're working on it, maybe. Actually, whether we had a full agreement on what everyone's working on, because my sense is that trading fee management is a pretty broad umbrella that really depends on who you speak to. You know, if you speak to somebody, for example, on a trading desk, they'll generally talk about kind of transaction cost analysis style trading fees, whereas I think there's an important statistic that about 65% of the cost of a trade are actually post-trade, and those costs tend to be managed somewhere else in any organization. So I think my key point would be that trading fees it's increasingly has to be viewed as a kind of an organizational thing rather than a departmental thing, and viewed in a very holistic way that basically to Nick's point, kind of cradle to grave, that has to include the entire trade cycle. I'm not sure that many people would probably include every element of that in the definition today.
Steve, I think one of the issues that we also have is that Steve, sorry. Yes?
Please go ahead.
Steve, can I continue?
Yes, please go ahead.
Yes, go ahead, Nick.
Okay, Steve. Yeah, just following up. One of the things that we've noticed is that it's not just the managing of the fee that now, because the market's moving all the time, and the market's a very dynamic environment. It's not just managing what you're doing today. It's thinking about what you're managing in the future and making sure that whatever you do, it doesn't require you to go back. It's something that some kind of future-proofing in whatever you do to make sure that you've got the holistic view of the situation, but it's ready for the next discovery or the next product that you're going to work in.
Okay, thanks, Nick. Well, I mean, what do you think are some of the risks inherent in ineffectively managing trading fees? If you want to keep talking, Nick.
So did you want to go? Did you want to go, Barney, on that one first of all?
No, go ahead, Nick.
I think the risks involved in trading, it's from my point of view, or from our point of view, generally, it's a cash management risk. If you look at the situation from an individual silo or an individual desk, there's an amount of money being paid for a service consumed, and something's happening there. But people don't look at the gross up. If you look across the organization, across all of the relationships you have, your risk is that you've got inferior cash management. You've got a weaker negotiating position if you want to go out and talk to the market about getting better deals from the market and getting savings. You need to consolidate that. If you don't consolidate, your risk is that you are paying out of the organization money that can be better used. From my point of view, the money that you spend in this kind of relationship, you can't trade it back in. In the front office, the guys will be trading, and there'll be good and bad days. But when you create a relationship and you have a third-party activity and you consume a service, you will pay at some point. So you want to get the best deal you can, and you want to make sure you have the information around that to reduce the risk and to manage the cash that you expend on that.
Okay, Nick, thanks.
Yeah, I mean, I'd broadly break that up. I mean, I think so I was just going to say, I mean, I think from a procurement perspective, I think that's true. But I think it's important as well, the kind of the knock-on effects throughout the rest of any kind of trading organization. Because I mean, if you look on a micro level, I mean, you know, you often hear of these stories where, you know, a trader, for example, has gone and done a trade where they think they're making some enormous great amount of revenue on it. But actually, because of the trading fee structure and because of the way that the entities might be structured or whatever, you suddenly realize that the deal is actually loss-making. So I think one of the important things about doing this properly is effectively being able to manage profit and margin rather than just revenues. And I think, you know, if you scale that out to the rest of the organization, you know, if you don't manage your trading fees properly, you can have a huge distortion in terms of actually where your resources are being allocated. You know, you can be spending money on areas which are very high revenue, which look great, but essentially they may be actually very, very low margin. And I think that's very true in Asia. If you look at some of the markets where, you know, fine, you can be bringing in some spectacular revenues, but the cost of trading in some markets, both from a brokerage perspective and a clearing and settlement perspective, are huge. So I think it's important to avoid that kind of distortion of you know, in terms of where you spend your money. To Nick's point, because otherwise you're just basically going to be spending your money on areas where actually you're not ahead of the game. You can just be financing a kind of you know, backing the wrong horse, if you like.
Yeah, I would agree, Barnaby. I think it's also possible now, the technology is now available, that if you have a system in place, it's possible that with the way we're talking about it, most of it is post-execution. Something's happened and we are looking to optimize ourselves around what has already happened. I think it's now possible to, on the higher value areas, more complex areas where the fees tend to get higher, you can actually find out what you're going to pay before you even pay it, because you're using systems to present the information to you and your trading in your trading strategies, and you can get a visibility of what you're going to pay. Not only will that be more efficient use, but it also may assist your trading strategy and make better use of how you execute into the market.
Yeah, yeah. I mean, I was just thinking aloud. I mean, one classic example of this would be DMA and algo trading. I mean, if you look, for example, you know, DMA by definition is high volume, high ticket volume, but relatively low, you know, ticket size. And you know, if you look at basically how, for example, if you want to execute a trade on an exchange and you want to clear and settle it, you've got basically a fixed fee that everyone has to pay in dollar terms on every kind of clearinghouse around the region. And so, you know, DMA can have a massive distortion effect in terms of your P&L just because of the fact you're being charged a fixed dollar fee every time you send a ticket through the system. And you know, so again, it can look like your revenue is shooting through the roof, but because the number of tickets you're generating is shooting through the roof, you know, if you're not tracking that accurately, you can end up with a very, very significant bill at the end of the month, and actually you can end up with a, you know, loss-making business where you think you're making tons of money.
Yeah, I agree. And I think at a minimum it's now possible, because you could do this kind of analysis as you're executing the trade, pre-execution, as you're executing the trade, you can see where you are in near real time. I mean, it may be more practical as a first step to do it at the end of the day, but you don't need to wait now for reports or bills coming in somewhat later in the period or in the next month or something. You can actually see where you are in near real time.
Okay, gentlemen, thanks for that. Well, let me go back to you, Barnaby. Do you think that organizations do have a clear understanding of where brokerage commissions and fees are being paid?
I think it's quite an interesting one, actually. I think, I mean, ironically, I think actually some of the smaller organizations tend to have a better clarity of sight than the larger organizations. In my experience, you tend to find, for example, a mid-tier brokerage will have, you know, naturally one person who's necessarily got visibility over the overall flow, you know, kind of soup to nuts, if you like. And as a result, you know, these people tend to be in a very good position to say, well, look, I can concretely say we've made this much money on a trade, or we've lost this much money on a trade. I think to the point I was making earlier on about the holistic view, I think the challenge is that when you go, when you scale into bigger organizations, you know, and you start scaling in, if you include within trading fees the headcounts that are associated with the trade support, you know, and the kind of the ancillary costs, those tend to very quickly get broken up across different departments, different cost centers. And so I think it becomes an increasing kind of specialism the larger the organization gets. So it's kind of ironic in my experience, at least, that the smaller organizations tend to have a better grasp of this. The bigger organizations tend to have a very sophisticated view on, for example, the you know, the transaction cost analysis side, pure TCA. But what we've referred to in the past as true transaction cost analysis tends to be fairly rare at the top end, and actually much clearer in the mid-tier.
Okay, Barnaby, thanks. Nick, do you want to add to that?
Yeah, I think that it's, I agree with Barnaby. What I would add is that I think a lot of organizations have a clear understanding of that brokerage is being paid. I think they find it hard to work out how much is being paid. I think one of the challenges is is who incurred the obligations and how they can roll that back to the originators. So it's not just the paying of the brokerage; it's how to genuinely assign that cost to the business and the department that's incurring the obligation.
Okay, thanks. Well, let's ask the audience. Here's our second poll. Does your firm have a clear picture of how much trading fees are paid? No idea. Performing simple cross-checks to previous invoice. General feeling of fee levels. Good picture of current changes. Full transparency of actual forecast. I'll give people a few minutes to vote. Okay, closed. Well, a split decision. I think some people didn't vote, but it says here 50% believe that there are general feeling of fee levels, and 50% have a good picture of current charges. Well, it's a bit surprising considering that the previous poll, I'll just put it up here for everyone to see, that when asked if firms have a strong need for better trading fee management, 75% said yes, I think so. Interesting. Well, let's skip on now to you, Zenon. You talked about several approaches during your introduction. What are the negatives of those approaches?
Yeah, well, thanks, Steve. I think what Barnaby and Nick had talked about a little bit before is they've almost preempted this question in a certain respect. I mean, there's one of the big challenges in larger organizations is the accuracy of the commissions and fees. So when you look at things like manual checks or spot checks, those are typically done by people rather than systems themselves. So one of the big areas of risk there is human error. I mean, even when you outsource to a BPO provider, whether that's a non-specialized provider or a firm that offers it as a value add, there's the human error element of things. And then a lot of it comes down to the sheer volume. I mean, with the approaches that certain organizations are doing, manual checks just aren't a possibility. As Barnaby mentioned before, when you're in a small organization, it's much easier to have a handle on some of these the fees and commissions that you're paying. But as the organization grows and is larger, obviously the number of trades that are happening is much higher and the number of transactions. So being able to do any of these kind of manual approaches is quite challenging. And then when you're dealing with an external provider, I mean, if it's a non-specialized BPO provider, so if it's just a general BPO provider that doesn't specialize in fee and commission management, then there's the human error along with the understanding of the business. We talk about this a little bit more in the report, but one organization that had outsourced to an external BPO provider, the BPO provider was kind of erring on the conservative side and raising a number of exceptions and resolving those exceptions while it took the financial institution less time to resolve those exceptions than it would for them to have manually checked all of the trades. It did cause some backup, and that resulted in late payments to in this case, to their broker, which then, you know, the payments are due from the back office, but then the broker complains to the front office and the people that are trading through the broker. So it doesn't result in a very good situation or relationship. So a lot of those you know, potential issues with these approaches can largely be mitigated with technology and with automation, because once the system is set up and configured to accept the feeds from different areas, it's as we discussed, as Nick mentioned before, it's a near real-time view into both how your business is doing and what you should be doing for the next trades. So those are some of the key downsides of those non-automated approaches.
Okay, thanks, Zenon. Well, Barnaby, I want to go back to you. One of the key findings in the Kapronasia report was that most companies use labor-intensive methods for managing commissions and fees. Now, as a service provider, is that what you're seeing in the industry? To what degree, and is this being addressed? And perhaps this is why the cost of a trade, as you mentioned, is 65% of the ticket.
Yeah, I mean, I think it's an interesting one. I mean, my experience is that there's what people think, and then there's what the reality actually is. To give an example, I mean, if you break the cost of a trade down, you've obviously, to simplify it, for example, you've got the commissions that you're paying out. You've got even, for example, the cost that you're paying to your agent bank to settle it, which are relatively straightforward and reasonably easy to automate. But what's quite interesting is that if you dig a little bit deeper, you then realise that there's a lot of kind of bits and pieces that actually add into the costs that don't really get factored into that kind of automated process. So for example, the cost of any borrowing. So for example, if somebody has a trade that's going to fail on the market, if they need to go and borrow the security to cover it, that trade very rarely makes it back as a direct allocation to the client. FX associated in Asia, for example, there's a lot of currencies where you're not allowed to hold long balances. So for example, that the cost of FXing in and out of, I don't know, Thai baht or Indonesian rupee is, I know people who spend inordinate amounts of time outside of necessarily the core teams that would track trading fees, but you do have one or two people spending 2 or 3 days a month just reconciling things like FX transactions, borrowing costs. So I think my overall experience is that people do claim, and I'm not surprised in a way that most people claim to have a pretty good view of actually what their trading costs are. But I think if you actually showed them, okay, have you really got all of these points covered, and if you could do a kind of a full spot check, if you like, I think you'd probably find that there were, I don't know, probably I'd reckon about 10 or 15% of costs actually missing from what most people class to be a comprehensive automated process.
Okay, thanks, Barnaby. I mean, Nick, as a BPO, you must have some views on this question. Can you tell us, are these labor-intensive methods being addressed? To what degree, and are they being prioritized?
Yeah, I think it's about we see it as an efficiency. Really, it's at a sort of a per item level. You're looking to get accuracy, and you're looking to pay the least or get the most, depending on which side you are. But from our point of view, when you put automation in, you're looking to have something which is neutral to the process, neutral to the kind of activity that you're the trading activity. But we are looking to mitigate what we would call noise risk. What Zenon alluded to, where there's so much going on that you cannot work out what the real problems are because there is so much going on, and the automation takes that away from you. So it provides you with accuracy and it provides you with process, but it also takes away the problems. When you do have to investigate a problem, it really is a problem. It's not something that you're just looking at because there's so much to look at. And I think when you want to be effective around that space, we talked earlier about better cash management, but I think it's also the ability to, once you've got that process in place and you are efficient and you are understanding it, it's the opportunity to then go back and look at what you're doing and create a better position from a negotiation. So I think the benefits of automation come twice to an organization. You get the initial cash management, the accuracy, consolidation, bit of reporting and views on things, but in the future you can also look at this and say, right, now I know how I want to change my system, now I know how I want to better negotiate, now I want to use my relationships in a better way. So I think it's a two-stage process. It's the automation and then how you use the automation when you've got good data and good statistics going.
Okay, thanks. Well, Nick, let's expand on that a bit more. I mean, what kind of information can you find with a clear and concise picture of a firm's trading fee cash flows?
I think probably Barnaby is probably a better view of this. From our point of view, it's we have, as Barnaby alluded to, we have a lot of clients who spend a lot of time developing their reports, and I think the process and the area is different for different sides of the street. If you are working in receivables, or if you're working in, then you're looking to provide competitive advantage. You're looking to provide a good service out to your clients and be efficient in that space. If you're looking on the payables side and you're looking to reduce your costs and be accurate and timely in that space, you want to pay the bills and people want to get paid. And I think the efficiencies of working with relationships and, if required, reducing the relationships to leverage the best relationships is what people are looking for.
Okay, thanks. Barnaby, do you want to add to that? I mean, what kind of information is available with clear and concise picture of a firm's trading fee cash flow?
Well, I mean, as I said, I think one of the key things is profitability versus revenues. I think is an important distinction. I mean, if you can tie down your trading fees, and you can get a good view of profitability and margin, then obviously an awful lot comes off the back of it in terms of how you incentivize your traders, where you invest your resources and things like that. But I think I think probably one of the important things going forward is to Nick's point about kind of being able to look into the future. Where you have platforms that really do give a kind of end-to-end visibility, including things like regulatory capital kind of requirements, and kind of the real kind of the extra stuff that really is the heavy hitting cost of the trade outside of what necessarily would be the kind of plain vanilla. Once you get into that area, then then you're really talking about a business that can really plan adequately for the future and do really good cost modeling about the overall business as a whole. A lot of the clients we have who use us for kind of end-to-end, it basically really comes down to a very good visibility and a lot of good ability to actually calculate commissions and to really be able to see way down the road for 3-5 years and be able to make investment decisions off the back of it. So I think to Nick's point, it is about procurement, but it's also about just the core tools that you need to manage your business.
Okay, thanks.
Steve?
Yes, Nick.
Yeah, sorry, I just want to say we sort of look at it as a circle. You start off, and the reason why you do it in the first place is clients do it because the obvious is cost savings and your ROI. But in the life cycle of what you're doing, you get leverage, and with that leverage you get transparency, and ultimately you get control. So what you get is control comes back to you. One of the issues with the disparate nature of fee and commissions and the lack of transparency is you don't have control. And one thing that we see is that working out what the touch points are, working out where you want to do this, and automating this process brings control back into the organization and puts you at the heart of what you want to do in this space.
Okay, thanks. Zenon, you started the conversation, so let's ask you the last question before we get to Q&A. I think you alluded to this a little bit in your discussion. How can you save or control costs with an effective trading fee management system, and what departments or stakeholders stand to benefit?
Sure, that's a great question, Steve. And we talk about this a little bit more in detail in the report. We kind of go through a list of the potential ROI areas. And clearly the first area is on the fees and the commissions themselves, and so that's a question across the organization. As Barnaby had mentioned before, it's the performance in the front office, and then the ability of the back office to be able to pay out on time and be efficient in what they're paying out. So there's a cost element for it. In addition, staff and productivity. So some of the organizations that we spoke to had talked about getting from some of their back office organizations, when they'd implemented an automated commission management system, up to 25% increase in productivity. And so for most organizations, that means that they can take 25% of the man hours that they used to dedicate to this and move it to a different function within the organization. So more effective use of the staff within there. And then on the IT side as well, certainly that you're getting much more out of the technology that you have, and we talked a little bit about the approach of using of building on existing systems. And one of the things that we found when we looked at the systems that were in the market is that it really, in this case, it really needs to be a so-called best-of-breed solution. You know, in large organizations, a large, looking at the technology side for a second, a large core banking system is great for maintaining the general ledger, is great potentially for CRM, but for fee and commission management, it's really, you need a best-of-breed solution. So in other words, a single tailored solution just for this space. And that's one of the things that we found is that to really get that technology advantage of using an automated system, it really needs to be a best-of-breed focused solution on fee and commission management, and a solution from an organization that understands what they're doing as well. So not added as an afterthought to a larger core banking system, but actually a system that's specifically designed for that.
Okay, thanks, Zenon. Barnaby, do you want to weigh in on that, or Nick, do you have a view?
Yeah, I mean, my immediate reaction is actually it's for me. I mean, I don't know if I'm oversimplifying it, but for me, trading fees are you know, an inherent part of just the trading system, you know, infrastructure. And at the end of the day, I think it's quite dangerous to separate one out from the other, because at the end of the day, if you're doing your trade, you know, if you're managing your trading fees right, then that should be dictating basically where you trade and how you trade. So for me, I mean, I think the natural answer is basically you know, if you know, how to do it right. I mean, for me, you've got to look at basically the overall trading infrastructure and say, well, okay, how, you know, how does my, for example, my TCA or my, you know, my overall cost of trading, how does that actually, how do I flow that back into not just my negotiating position with third parties, but also how do I flow that back into how I trade in terms of which broker get my flows, which markets I trade, which agent banks, you know, I settle with, and so on and so forth. You know, I think to view it as individual pieces, I think large organizations have the luxury of that, but I think probably the majority of organizations in Asia would have to, I think, would benefit from viewing it as a single integral perspective.
Okay, thanks, Barnaby. Let's move it to the Q&A. We have two questions here. Well, how much commission is over or underpaid in your estimate? I'm not really sure who I would direct that to. Perhaps Zenon in your research, or Barnaby in your experience. Do you have any estimations on how much commission is over or underpaid?
I think in some of the examples that we looked at, it seemed to range from 2 to 6%. In many of the cases, and some organizations were reporting up until 10% with the general ranges that we found. But as I mentioned before, I mean, getting some of that information out of clients is a little bit difficult because nobody wants to talk about how much they've overpaid. So some of that is down to estimates. I'm not sure if Barnaby, if you can speak from personal experience of what you've seen.
No, I mean, I honestly, I'm slightly biased because I mean, the platforms we have here calculate commissions for our clients in terms of outward payments, along with everything else. So I'm bound to say that 0% overpaid and 0% underpaid.
Well, that sounds.
Yes, that sounds like a nice ideal.
Yeah.
I think again, it's a very sensitive area, but I think I think Barney would be the first person I've come across that has a zero impact and zero tolerance. The nature of solutions, manual solutions, and ad hoc activities tend to lead you to a tolerance approach to the solution, which will give you, and those kind of benefits can be taken back by automation. So even if you don't have a number, what you do know is that there is a number, and every 1% that you get, you bring back as a fraction of your total cost will probably outweigh the cost of automating the process. So the ROI is there for you.
Makes sense. Well, we have a question that's kind of related. If commissions are being paid or underpaid, are there in fact trading fees left in segregated accounts that are unclaimed? Is there just a pile of money sitting there Perhaps that might go to Zenon or even, well, I guess not Barnaby with the 00, but what do you think, Zenon? Do you see any trading fees left in accounts that that have been unclaimed?
I wouldn't have too much insight into that area. I can't really comment on that.
Okay, fair enough. I guess it is kind of specific, and I think brokers probably don't like to admit they have unclaimed commission brokerage sitting in their account. I guess particularly with MF Global in the news, no one's really going to volunteer that information. Well, that's all the time we have for today. I don't see any more questions. I'd like to thank Nick, Zenon, and Barnaby for their time and insights on this topic that will certainly gain more traction as firms seek to lower costs. I certainly learned a thing or two, and I hope our audience has as well. Just for your information, this webinar has been recorded and can be heard again by visiting asiaetrading.com/webinars, or you can hear this webinar on your iPhone through the Asia eTrading app. Just visit the iPhone App Store and search for Asia eTrading, and it's free to download. That concludes our webinar today. If you have any questions about this webinar, future webinars, the research Zenon has provided, please contact me, Steve Edge, at support@asiaetrading.com. Thank you all for attending an Asia eTrading webinar, and we hope to see you all again soon.